So this is a video about about the capital asset pricing model, and you can find my outline on my website researchata.com. But keep in mind, it's an introduction, and most detail can be found in your textbook. So the capital asset pricing model, I will just go through from the model itself and try to explain its components and why we're doing this, and possibly talk about some examples along the way. So let's start with looking at the price chart. This is a candle chart of S&P 500 index. And as you know, this year was a rather interesting year. We started somewhere around February to increase in prices. And then we had a COVID-19 financial crash. And then we had a very nice and steady recovery of the market. And then for the past few months, it's been a volatile market because of the expectation of the stimulus and the election. And tonight is the night where when we're waiting for the results of the election. Are we going to have a new president, or are we going to have the same president for another 4 years? So the market has been quite volatile. So the question really is there any way that we could explain this return? Or is there any way that we could explain this return? So what made it so that the price actually went up this way, right? And, we're not talking about causation, obviously. There are several reasons. We had a stimulus package right here, another stimulus package, another stimulus package. And we had a problem within the government between Democrats and the Republicans. And it's been a very hectic year, to say the least, and I'm sure there's more to come. We had 11 hurricanes this year. We'll see what's next. But anyhow, so we are trying to figure out what happened to price, to returns from perhaps that bottom of the market to the top of the market. And that really is the holy grail of finance. Can we explain the return? Can we model for it, right? So the capital asset pricing model is one of the oldest and undoubtedly one of the most popular models that tries to do exactly that. They try to explain, or the model tries to explain the expected return of an individual asset. So for instance, let's take Apple, a company stock price going from $53 all the way to $138 in a matter of about 6 or 7 months. And that's a substantial return. So can we explain that return in any meaningful way? So obviously, the first step is to define what would be the minimum return that we should be looking for. So for instance, if you have a checking account or a savings account, we earn minimum, and sometimes we earn nothing. But obviously, when you start making investment decision, you have cash, you're leaving your cash to open up a checking account, and then you are leaving the convenience of a checking account and opening a savings account. And then you're leaving the convenience of that savings account and perhaps buying a bond or buying a stock or buying some other financial security that gives you a substantially higher return than a checking account, for instance, but you are taking some level of risk. So then the minimum, that you should be looking for is, what we define as the risk-free asset. In this case, when you look at your checking or savings accounts, you have an FDIC insurance up to a certain level. And FDIC is the Federal Deposit Insurance, and you have the full faith of the government behind it. But the U.S. Department of Treasury is the government itself, and they have bonds that they issue that we can buy. And every day we have auctions for these bonds or U.S. Treasuries. Their maturities vary from 1 month to 30 years. Up to 3 months, we kind of refer to them as risk-free financial assets. And just for the sake of argument, let's look at a 1-year investment horizon, and that's about 0.12%. And yes, it's really, really low. But it is what it is. So we have a student managed investment fund, for instance, and we have $1 million in it. If we were to invest our $1 million into this, there really would be no work to do. We would just buy these US Treasuries, go to Bahamas, sip our pina coladas, and earn our 0.12% without any work. We don't have to do any financial analysis. We don't have to really do nothing. So, and we would earn our 12%, 0.12%, which is very minimal. So we refer to this as the absolute minimum required rate of return. And in our model then, every asset that we choose to invest must return to us at least the bare minimum of that risk-free return. Meaning there would be no point of investing in anything else if we are not getting at least that 0.12%. Why should we? We could simply buy the US Treasuries and enjoy its risk-free status and doing nothing and earning 0.12%. But we choose to invest in a individual stock or the market, and therefore we should at least be hoping to earn that required return, the minimum return for our investment. Now, that's our absolute minimum. Then we're looking at the overall market. This is the S&P 500. And in fact, there's an ETF called SPY, which allows us to buy a share by paying $343 and change of a portfolio that includes 500 largest stocks in the world. And the index itself is called the S&P 500. And through this ETF, and there are others that allow you to do the same, we can simply buy into a portfolio that is, really well diversified. 500 companies in the portfolio, value weighted. I mean, for me personally, it doesn't get any better than that. But then the issue, if you look at the market, look, we started out here, we came from this point all the way down here. And then from that point, we recovered well. But if you look at it, we're right actually where we started, right? Perhaps a little bit better, right? So I'm thinking I could have actually done better. Would it be possible to invest in an asset that does better than the market? So then I'm looking at companies, because looking back is easy, right? 2020 hindsight. So we look at companies like Boeing, they've done really bad. I mean, compared to the market. If you look at, say, American Airlines, they did really bad compared to the overall market. If you look at, say, Marriott, they didn't do all that well. I mean, look at Exxon. They're actually almost as bad as when the market crashed for the coronavirus. But when you look at the technology companies like Apple, well, Apple actually outbid the market. Or if you look at, say, financial companies like Bank of America, they did really bad. AT&T, they did really bad. Exxon, they did really bad. Citibank, But Netflix, technology company, look at that. We've actually done really well. If you look at Google, we've done really well. Amazon did really well. Tesla did really well. So it is then possible to invest in an asset that outperforms the market. So the ultimate purpose really is in portfolio selection is to choose the best investment that would bring you the highest return with the minimal risk. But first we establish that we have the minimum required rate of return, meaning if we take no risk, we still earn the 0.12% risk-free rate. But then by investing in a very well-diversified portfolio like S&P 500, we could earn the market return. Well, in this case, the market return is the S&P 500. And it really is not much work. You buy the ETF, market goes up, you make money with the market. Market goes down, you lose money with the market. And there really is no, work. You mimic the market, you proxy the market. But the art of the portfolio management, and obviously the aim of the portfolio management, is to choose that asset that you expect, you hope, to outperform the market. So let's say that we're going with Apple. And Apple, we know, looking back, has outperformed the market. So we have the absolute minimum, that's your risk-free. Then we look at what we refer to as the risk premium. This is the market return that is above and beyond investing in the risk-free, which means by choosing to invest in the S&P 500 index, for instance, or in the market, we are leaving the US Treasury return behind, and therefore we should be earning above and beyond the US Treasuries. So the risk premium then is the market return minus the risk-free. That is how much return we made above and beyond the US Treasury risk-free. So then the correlation of our individual asset with the market becomes an issue. Meaning, I want to know if I'm going to choose an individual asset, how well is it correlated with the overall market? Because you see, it's really easy to invest in the S&P 500. You buy the ETF, and then that's it, you're done. So, you're talking about our student managed investment fund, $1 million. Day one, what do? Well, our objective is to mimic the market. And I'm like, okay, we're done with the course. What are we doing? We're investing in the SPY. And then, well, okay, well, you all get A's and we're done. So obviously that's not the intent. Intent is to find this individual stock. And next quarter, obviously, it could be a different stock. It could be that Boeing outperforms everybody. So that's the intent of our portfolio management. But I need to know then how correlated individual assets are with the overall market. Because if an asset like Apple or Boeing or Disney are highly correlated with the market, then what's the point of investing in them? It simply would mean that if they are perfectly correlated, it would simply mean that as market goes up, they go up with it. If market goes down, they go down with it. Then there really would be no point of investing in an asset that is perfectly correlated with the overall market. Then we need to know that correlation. So the model then is the expected return is a function of risk-free, absolute minimum return, and the correlation of the individual asset with the overall market risk premium, or the market return that's above and beyond the risk-free. If you go to this video, if you just click on this, it takes you to a video on YouTube that shows you how to estimate this using real data, using Stata. And I also have some lecture notes that that shows you how to do this with Excel. But for the purposes of this lecture, I'm just going to look at some examples that are already estimated for us. So let's go to Yahoo Finance. And let's take a look. So this is our S&P 500. And obviously, when you look at Apple, you know that it has outperformed the market. And when you look at Boeing, we know that it actually underperformed the market big time. So let's take a look at the betas, or the correlation coefficients of these individual companies with the overall market. So let's take a look at Apple. The beta is 1.31. Now, beta can be any number. It's a correlation coefficient, but it can be any number, meaning it can be 2, it can be 5, it can be 10. It also can be negative. So a beta of 1 simply means that the individual asset moves, the returns of individual asset moves in perfect correlation with the market. They actually just simply move together in the same, right? And but notice in our function, we have an intercept, in this case, the risk-free. And I just choose to ignore it for the time being, simply because it's kind of easier to explain this without the confusion of the intercept. Intercept simply means that there is the risk-free, the minimum return, and then above and beyond, we have the risk premium that our individual asset is correlated with. So in this case, Apple has a beta of 131, which translates roughly into, as the market moves by 1%, our individual asset, in this case Apple, moves with it 1.31%. So the market moves up by 1%, our stock moves up by 1.31%. But market goes down by 1% and the Apple goes down by 1.31%. So they move together, but Apple is moving a little bit more than the market. So 131, we refer to it as it actually has a higher market risk than a company or a market portfolio, or a company that has a beta of 1, a perfect correlation. So we are slightly higher correlated with the market, and slightly higher, or bear slightly higher market risk. So let's take a look at Boeing, which we know underperformed the market. So let's take a look. So it's interesting because Boeing, we know underperformed it, but it has a beta of 138. It simply means that if market goes up by 1%, beta goes up by 1.38%. If market goes down by 1%, we would expect the company to go down by 1.38%. So, with respect to the market risk, Boeing seems to be a little bit riskier than Apple, but still significantly correlated with the overall market, and it has a relatively high market risk. Now, notice how Apple actually had 131 and Boeing had 138. And when you look at Apple right here, you see a very nice outperforming the market. But when you look at Boeing, we did not perform, and the betas were almost the same. So how is that possible? Well, beta is not a performance measure. Beta is a risk measure. When we look at the correlation with the market, you're looking at the daily return of an individual asset and its correlation with the daily returns of the market. So it is not a performance measure, it is a risk measure. Therefore, having a beta of 131 and then having a beta of 138, yes, they're very similar. It simply says that Apple and Boeing are similarly, or Apple and Boeing have similar market risk exposure. Let's look at some others that I have on my list. Let's look at Disney, for instance. I would expect Disney to have a higher beta. And I'm not sure. Oh, well, I was wrong. Beta has, Disney has a 1.10, which simply means that it has a lower market risk compared to Boeing and Apple together. So if you look at, say, American Airlines, I'm almost certain that it actually has a significantly higher beta. Yes, thank you. This time I was right. So the American Airlines have 1.76, and that is, as if market moves up by 1%, you would expect American Airlines to move up by 1.76%. And this is actually 5-year monthly. So this is not like the coronavirus period. This is a longer period beta. So, but anyhow, when the market goes down by 1%, you would expect American Airlines to go down 1.76%. So American Airlines have a significantly higher market risk than Boeing and Apple. So let's try to find a company that would be perhaps Exxon, that would have a little less market risk, simply because Exxon is more of an oil and commodity company. And again, I was wrong. So Exxon has a beta of 131. It's the same beta that we had for Disney. And so it is what it is. How about Procter & Gamble? Let's check it out. Procter & Gamble beta, well, yeah, thank you. So the Procter & Gamble has a beta of 0.41. It shows market independence. It simply means that as market moves by 1%, Procter & Gamble moves by 0.4%. Market goes down by 1%, Procter & Gamble goes down by 0.4%. So there are probably more of corporate reasons why Procter & Gamble would move than market reasons. So if we define risk, into two, distinct categories, one category would be the risk that is specific to the company, corporate risk, and then the second would be the risk that's specific to the market. So the beta really is the market risk. So in this case, Procter & Gamble has very little market risk. So I personally assume that the Procter & Gamble would actually have more of a corporate risk, idiosyncratic risk, a risk that's specific to the company. And that's actually much, much harder to measure. So let's focus on what's easier for the time being. Let's look at, say, Amazon. I would expect Amazon to have a higher beta. Well, it's actually somewhere between Disney and Apple, about 1.35. It's a tech company. Just want to see, like, JCPenney, one of the failing companies of retail, and the beta is 0.27 at 13 cents. Macy's, perhaps, that has a 1.59, right? So you do get the idea now that, when I said beta can be 5 or 10, that's actually absolutely rare. You're looking at, especially when the companies are within the S&P 500 realm, within the companies that are listed in New York Stock Exchange and NASDAQ and have a sizable market cap, then you're talking about betas that are within maybe 1, maybe 2 range. But anything above and beyond that, we would consider them to be very high market risk companies. So, well, that's actually about it. So with respect to how to estimate this, if you want to estimate it yourself, you can find it in this video. And there's also an additional video about how to create a portfolio. And one of the assignments that I have is that you need to create a portfolio that has a beta of 1. But with respect to the introduction to capital asset pricing model, that's all I have for this video. And keep in mind, this is an introduction, and more can be found in your textbook and through my lecture notes. So if you have any questions, please do let me know. Well, thank you for watching. All right.